What's up, investing legends? Today we welcome Louis Rogers to the program. Louis is the CEO and founder of Capital Square, a leading real estate sponsor specializing in tax-advantaged real estate investments. Louis is an attorney by trade that has a tremendous amount of knowledge regarding real estate investment tax strategy. And in today's episode, we dive deep into the various tax deferral mechanisms that Louis specializes in. And this show is a doozy. We start off the episode with Louis detailing the history of the 1031 exchange and the evolution of tax deferral mechanisms that real estate investors have used over the decades. Later on in the episode, Louis talks about the Delaware Statutory Trust and how investors can retain the benefits of real estate ownership by staying in a Delaware Statutory Trust that is absorbed by an UpREIT. I had never heard of an UpREIT before until this episode, and trust me, there is a lot to learn from Louis concerning UpREITs. I have been a massive critic of REITs for a very long time, but Louis lays out some very interesting arguments for the benefits of REITs, specifically when exchanging into the REITs via a Delaware Statutory Trust. Lots of gold nuggets in that section. And then finally, we conclude the episode with Louis detailing some of the calculated risks that he's taken over the last 10 years that have led him to build an $8 billion portfolio of real estate under management in just a little over a decade. Louis is the real deal, everyone. And if you are a sucker for tax strategy, specifically tax strategy surrounding real estate investing, you do not want to miss this one. So without further ado, let's welcome to the program, Louis Rogers.
Welcome to the Investing Secrets Podcast.
Louis.
Yes.
Welcome to the Investing Secrets Podcast.
Thank you. Love the name of your podcast.
Yeah. Well, hey, are you ready to step inside the vault with me?
I am ready for pure gold.
Let's go, man. Love it. Love it. Love it. Well, let's just start, Louis, because, we could take this a million different places, but we were talking offline here before we started that, you've really got a lot on your mind. You've seen kind of this transition over the last 40 years from investors opting for single family rentals now into investing into larger, more passive real estate investments. So talk to us about that trend. I want to hear kind of like where your thoughts are with all of that.
Sure, absolutely. I'm a tax lawyer by training, so a lot of what excites me is the ability to defer and exclude taxes. So
me too.
When I started in the spring of '84, I shouldn't say before you were born, but probably before you were born, I was hired as a baby tax lawyer. A large national law firm had the first computer, and I was told to know everything there is to know about this little code section 1031. What is like-kind real estate? They sent me in a closet, and I came out 3 days later, and 40 years later, guess what we're talking about? Still talking about section 1031. We learned how relatively easy it is to structure an exchange and defer the tax. We only got there through the support of Congress. Congress could have repealed Section 1031. It's been in the code since 1921. And about every 10 years, someone says we should repeal 1031 to generate extra tax revenue.
Yeah.
And the various trade associations, Ernst & Young and economists present statistics that show that having a liquid market creates revenue for the fisc, and 1031 is good for the country. It creates a liquid market. People can trade out of a property that doesn't fit them. Somebody will pay full price because it fits the buyer better than the seller, and it works really well. So over these years, we've gone from regular folks exchanging their rental house. And that was kind of the starting point is I own a duplex or a single family home. That's what my parents did. Their hobby was investing in real estate.
Yeah. And
they used to say, when you own real estate, you always have access to capital. You have to work hard and there's risk, but if you put your heart into it, you always have access to capital. It put me through college. It put me through Oxford in England, a couple of degrees, and through law school. And so that real estate really launched me into being a 1031 tax lawyer at first. And everyone was trying to figure out how 1031 worked. And it's a little known fact that the IRS and Treasury have supported 1031 for all of my 40 years. Rules, regulations, revenue rulings, revenue procedures. If we hadn't had guidance going all the way back, we had the Starker case, right? When Mr. Starker sold timberland in the West and had years and years to find replacement property. And the Ninth Circuit said that's a good 1031 exchange. That's a delayed exchange. That got things started. And then the IRS started giving guidance on how to do an exchange. And the IRS gave us safe harbor. Can you imagine the IRS creating a safe harbor so people could do exchanges? So regular folks could do exchanges. I know for a fact, because I was in the swamp for a private letter ruling meeting with the people when one of the nice ladies said, my mom has a rental house and she can't afford rich, fancy tax lawyers like you. And the tenants don't pay the rent, tenants, toilets, and trash. It's making my mom crazy. She has all this wealth built up in this rental house, but she can't sell it because of the taxes. She said, we need some rules so my mom can do an exchange. And guess what? The next November, we had the safe harbor for qualified intermediaries that gave us, the IRS created a safe harbor telling regular folks how they could do an exchange. And it's been like that for years and years. The IRS has given rules on reverse exchanges, on delayed exchanges, you name it. The rules have been very favorable almost across the board. And so anybody can do a 1031 exchange today if they have investment or business real estate, not your principal residence. And so that has been a miraculous thing. Part of what excites me is helping families build their wealth over the decades by exchanging over and over and over again. We call them serial exchangers, not because they eat Rice Krispies, but because they exchange over cereal with an S. And it caused me to write a little book called Section 1031 Exchanges, How to Swap Till You Drop, Building Family Wealth While Minimizing Taxes. And that got me really excited, seeing how people could help their families over decades. And a lot of my experience is not being a boring tax lawyer to talk about Section 1031F related party exchanges that would put you to sleep, but to talk about how regular folks can improve their lot in life. And my favorite client was named Willie. Willie's in the book. He had 12 acres on a very valuable intersection, but those 12 acres didn't generate any income for him. It was just a piece of land. It actually cost him money. Think about it. He had to pay taxes, insurance, cut the grass. And so Willie had this valuable asset, but he was a postman. And he drove what we call a raggedy ass pickup truck, had rust holes, and he was a working stiff. And when the Walmart buyers showed up at his house, he took his shotgun out. And they came back and he took his shotgun out a second time. And they said, Rogers, can you go in there and talk to this guy? He's crazy. And I said, okay, Willie. Willie, do not shoot me. I just want to drink some iced tea and rock on your porch the way we do down south. And I said, Willie, what's bugging you? And I'm not being disrespectful, but this is a $10 million, $20 million property. Think about all that, think about what you could do with that money. And he said, I'm not paying $1 million in taxes. I'll die before I pay $1 million in taxes. I said, Willie, my specialty is 1031 exchanges. You'll never pay the taxes. He said, what do you mean? We're going to set up an exchange and you're going to invest the sale proceeds in investment property. What kind of property? Property you like, Willie. He ended up buying a couple of net leases. He never paid the tax. He was the happiest guy on earth. And he said, where's the contract? He signed the contract the next day. He never paid $1 million in taxes. He deferred the taxes by exchanging for qualifying investments, which is just basically investment real estate. It generated an enormous income. He was able to take his kids and grandkids to Europe. He was able to put his kids through college. He was able to do all sorts of things for his family. And, 1031 is about tax deferral. You defer the tax. And when the time comes to sell the replacement property, you're on a little bit of a treadmill, right? You have to do another exchange. But that's your option. You're in control. That's why I wrote the little book, is to let people know every time you have a sale opportunity on your investment property, you can do another exchange and another exchange. And then when inevitability occurs and we meet our maker, our heirs get a step up in basis and the tax is essentially forgiven. So Willie deferred the tax throughout his lifetime over and over and over again. Unfortunately, he passed a few years ago. His heirs got the step up. They were able to sell the real estate and converted tax deferral into tax forgiveness. And that was a very powerful story for Willie and his family. He didn't have to work anymore. He had so much money coming in from his properties that he bought a pink Cadillac like Elvis. And when I went to see Willie about 6 months later, he took me in the garage. He was so proud of that Cadillac. And I looked down at the odometer. Guess how many miles he had on it?
How many?
12. Said, I hate this car. And he kept driving his raggedy ass pickup truck, being happy as a clam.
Yeah.
So that's kind of the starting point of how one little code section from 1921 has helped families dramatically improve their lot in life. And over the years, the 1031 business has evolved. As a tax lawyer starting about 1990, I was getting phone calls from, we call them sponsor companies today. My company's Capital Square. We're a sponsor company. We sponsor real estate offerings. But back in that day, they were called syndicators. I won't say sleazy syndicators, but it rhymes with syndicator. I was getting calls from California syndicators asking if we could take a big, beautiful building to riff off of the One Big Beautiful Bill. Could we take a $50 or $100 million building and break it up into little pieces so regular folks like Willie could own a piece of an investment grade property, right? Most people have, 50, 100,000 in that day, maybe 250,000, but they don't have $50 million.
Yeah.
So they're not able to buy investment grade property. And in the early 90s, the question from those guys in Santa Ana, mostly in California, was how do we break a property down so that regular folks can 1031 exchange into it with a sponsor who would manage the property and take care of the asset management and the leasing and pay you a monthly distribution and make active real estate passive? And the answer is yes. Yes, West Coast sponsors. I did go to Oxford, not in Mississippi, but in England. And I studied English common law. And there was a concept called tenants in common. And so we took these buildings and we broke them down into a structure called TICs, not because they suck your blood, but because they are undivided ownership. And took that concept, actually stole it from a West Coast lawyer and made it friendlier. Daryl Steinhaus worked for Pasco as their outside lawyer. He's a lot smarter than I am, so I stole his work and then made it friendlier. So it would be more business friendly, and took that to the broker dealers of the world and created a whole new industry called Tenants in Common. We created the Tenant in Common Association, TICA. It's now called ADISA. We're about to have our convention in Vegas with thousands and thousands of people. And that created a whole new industry so that, the Willies of the world could 1031 exchange into a managed investment grade property and not exchange into just another rental house. Because lots of those folks are tired of the tenants, the toilets, and the trash. Yep. They want to go on vacation and not worry about getting a phone call about the roof leaking or the toilet running and that sort of thing. And the demographic of people my age, when we're your age, buying rental property is phenomenal. And you can get in there with a hammer and sheetrock, and you can add a lot of value. When you get a little bit older and you're, working 12-hour days as a lawyer billing clients, you don't have time to do the labor anymore. I didn't. And so I exchanged into a tenancy in common. Yeah. And then when you get to my age, you want to cruise, right? You want to go see things, go places, have fun, go with your kids and grandkids. And so a passive investment works a lot better for the lifestyle. We can't sell because we have low tax basis and would generate an enormous tax, especially in California, New York, New Jersey, right? State taxes on top of the recapture tax, on top of the capital gains tax. It's too expensive. We have to exchange. But if we can only exchange into another rental house, we haven't really accomplished our life goals of getting out of active management. Or in Willie's case, we're not able to take a non-productive asset. He just had a piece of land, right? Wasn't generating income. It was costing him taxes, insurance, maintenance. He was able to take a negative and make it into an enormous positive. Yep. Those things have really proved to be phenomenally successful. The TICs worked perfectly well until the great financial crisis. Most of the sponsors in that day, today, most of us sponsors are multifamily, but in that day it was suburban office, and suburban office was crushed in the great financial crisis. And so the tenant in common structure had a stigma that was really more the great financial crisis. When we came out of it as an industry around 2012 or so, when Capital Square was formed, we switched to a different structure called the Delaware Statutory Trust, the DST. Mm-hmm. Again, the IRS gave us the DST in a revenue ruling, which is, that has the power, the force of law. The IRS didn't have to tell us how to do a think about it. The IRS is giving us a rule on how to take a big building and break it down into little pieces so regular folks could do an exchange. They didn't have to do that. If the IRS and Treasury didn't support 1031, they would have given no rules or really harsh rules. But, the original research for me in 84 was what's like kind. What's like kind to real estate? Guess what? Real estate to real estate is like kind. So you can go from, think about it, is land like kind to a shopping center or an office building? Not really. Or an apartment like kind to a hotel? Those things doesn't sound like kind, does it? The IRS said it's close enough, it's like kind. So the IRS has supported us. We were able to take these buildings and break them down into TICs. That business was caught up in the great financial crisis and all those horrible things. A lot of those properties were foreclosed on. Investors lost money. And the TIC was a tax structure, and it required things like unanimous consent. Can you imagine getting 35 investors who don't know each other to consent to something important, like a leasing concession to get a renewal? Many granny in tennis shoes refused to sign concessions, and that led to the demise of many a property. When business people would say, you have to pay leasing commissions, you have to give tenants concessions, fill your building, keep them going. The TIC structure was flawed, but the DST structure doesn't have those flaws. It has a sponsor like Capital Square that is in charge, makes the decisions for the investors. It's passive. If you make those decisions wrong, you're going to be out of business, but you won't lose your property. If you make the decisions right, the investors will stay with you. When the time comes to sell a DST, most of the investors will do another exchange and another and another. There are the classic serial exchangers. About 5% of Capital Square's investors cash out because they've gone to an estate. It's now the heirs. So, out of every X dollars, 5% will cash out. They've had to step up in basis. They don't need to exchange anymore. They don't need to swap till they drop because they've dropped. But the next evolution in this 40-year process is the DST is a quirky little structure. It's a fixed investment trust. You can't change very much. You can't add much value. You can't refinance. It's a tight box. It's a really tight box. And when the loans mature, let me back up. 1031, if you have debt on your relinquished property, you have to have equal or greater debt on your replacement property. Most people have 30, 40% leverage. So a DST on average will have 30, 40, 50% leverage because that's what people need. Now, some people have no debt and some DSTs have no debt, but most of them have 30, 40% for those investors that need debt. I forgot where I was going with all that.
Well, I mean, honestly, Louis, like you were on a roll there for a second, so I was just letting you go for it.
I'll get the thought back here in a second.
So speaking of
I got my train.
Go for it. Yeah,
I got a train. So when a DST matures, the property has to be sold, right? Yep. Investors started saying to Capital Square and other sponsors, "I really like my property. I would like to keep my property. It's a perfectly performing property." And we say, well, we're under a revenue ruling that says the property must be sold. Other cases, we have a property that we could add value. If we could put a little more money into the property, upgrade the kitchens and the countertops, and we could increase the cash flow dramatically and add value. But none of those things are really possible in the DST structure. And so as an industry, the sponsors said, why don't we find a structure where you can keep your property? And we do that by forming a real estate investment trust, a REIT. A REIT's a corporation. You cannot 1031 exchange into a REIT. REITs own their properties in an operating partnership. It's called an UpREIT, an umbrella partnership, because on the org chart, the real estate's at the top. Call it an UpREIT. You can't 1031 exchange into the REIT. You have to 1031 exchange into real estate, and then you can contribute that real estate to the REIT. And so it's a two-step process. It's kind of the Texas two-step. You 1031 into a DST with a sponsor. The property matures. When the time comes to sell, the property is appraised, and the investors are given the option of going into the REIT. Now, they can do another exchange by taking their cash, or they can cash out if there's been a step up in basis and the heirs are the ownership, right? They've gotten a step up. There's no more tax. There's tax forgiveness. And so at Capital Square, we said, okay, why don't you keep your property? We will UpREIT them into the operating partnership of Housing Trust, Capital Square's REIT. And now you get the ultimate tax deferral, unlike the DST, where the properties have to be sold and you have to do another exchange and you can't add value because it's a fixed investment trust. You can't refinance because that's prohibited. Now the REIT is basically unlimited in what it can do to add value. You can park in the REIT for the rest of your life and not have to keep swapping till you drop. And what we find is as you get closer to dropping, you get tired of swapping. It's kind of have fun with 1031. We do a lot of seminars and it's a fact. When you're younger, you enjoy the game. I invested in a property and my 100,000 is now 150 or 200,000. Great. I'm going to do another exchange. And another and another and another. But when you get to be in your 70s or so, you say, gee, I'm really kind of exhausted by all this. When you're younger, you think it's fun. When you get older, you say, can I just park? And when you park in the operating partnership, instead of being a single property in a single location with one set of tenants, now you own a piece of the operating partnership's properties, and it could be billions of properties. And so if you have God forbid, if you have a catastrophe at a property, you have 19, 20, 50, 100 other properties to support it. if insurance premiums go crazy on you like they did in coastal markets, you have lots of properties in the REIT that are not in coastal markets where they don't go crazy on you. And so you are diversified, so well diversified that you can park in the REIT for the rest of your life. And then when you pass, your heirs can get the step up and cash out. And so you can get off this treadmill that I really like the treadmill. That's how I made a living for all these years. But as you get older, you get exhausted by the process. And that's really I think of it as the institutionalization of regular folks, regular everyday people. Because I've gone from a duplex on Main Street in somewhere town, USA, to an interest in a REIT that is listed on the New York Stock Exchange, where I can trade my operating partnership units for REIT stock and sell on the New York Stock Exchange. I am now a part of an institutional ownership, the best properties in the best markets with the best managers, with the best. When I started with a stupid rental house in some little town somewhere, it's been a phenomenal upgrading of the investment for regular folks.
Yeah, Louis, so much to unpack there. And
Good luck.
I think where I want to start though is the DST to the UpREIT.
Okay.
And that process. So, and by the way, I was not familiar with UpREITs until this conversation. So this is a new concept for me. Explain that process in maybe a little bit more detail. So
Sure.
you're exchanging right into a DST, and we've had plenty of other guests on the show before that are DST experts and that talked about the DST, and
Right.
I've had exposure to DSTs for well over a decade now. So I understand the concept, but then the DST then is absorbed by the UpREIT. What does that process look like?
Let's go through the process. So you 1031 exchange into a DST.
Yep.
Under the revenue ruling, that's a good exchange.
Yep.
That property is now held for investment. It needs some time to grow and mature. And when it reaches its potential, it has been as little as 5 years, but most loans are 10 years. So definitely at the end of 10 years, the revenue ruling requires a sale. So somewhere between 5 and 10 years, your $1 million investment has appreciated. You'd like to get a 2 times equity multiple. Mm-hmm. So let's say your $1 million has become $2 million. Now there's 2 kinds of UpREITs. It's somewhat controversial, but the wirehouses are wired towards a mandatory UpREIT. They say in 2 years from acquiring your DST, we're going to put you in the REIT. Mandatory. That's not the way Capital Square does it. We're voluntary. We're not wired at 2 years. We say when the property matures, we get a full-blown MAI appraisal, and we give you your value in cash for another exchange if you want. We're in the exchange business. We're thrilled when investors stay with us and do another exchange, or cash if it's an heir, if the heirs have taken over and don't need to do another exchange, or you can have that value in OP units. So you say, I started with $1 million. I have $2 million. I can go into the operating partnership and I own $2 million of OP units, or $2 million in my QI account to do an exchange, or $2 million to my heirs who've gotten a step up and don't need any more tax deferral. That's the starting point. Now you are a partner in the operating partnership, and that's where the REITs own all of their real estate. So you have $2 million of what could be $2 billion of property. Mm-hmm. And that's where the diversification comes, is that you're now an owner of that entire pool of properties. Should one property go bad, you have lots of properties to offset it. And that's the safety element.
Right. And with the DST, typically you're just an owner in one. It's almost like a syndication.
Completely undiversified.
Yep.
I was going to say, but one of the DST benefits was the ability to diversify because the minimum is very small. So if the minimum investment is $50,000 and you have $250,000, you could go into a small portfolio of DSTs.
Sure.
The ticks were $1 million minimums. So people were putting all of their eggs in one basket, 35 maximum slots. But today you can diversify. And so you don't have all of your money sitting in one property. You have it spread across a number of properties. That's one of the best benefits of the DST.
What commercial real estate asset classes have you seen utilize the DST?
Sure.
I'm familiar with like shopping centers, like say like a Costco or something like that. But what other outside of like retail, what other types of asset classes?
You can put any of the real estate asset classes into the DST. If it's active, like multifamily, you put a master lease on top of it. If it's retail, it already has a net lease on it. Mm-hmm. But it has to be passive to the investors.
Yep.
When Capital Square started in 2012, we did medical office, industrial. They were all triple net leases. Easy to manage, no muss, no fuss. But over the years, we have transitioned into different segments of multifamily. And we found that the net lease only gets you so far. Let's say you have 10% rent increase every 5 years. Well, we had 20% inflation in 2021. Mm-hmm. It didn't cover inflation. And we have a single tenant, and there were good single tenants, but we had a single tenant risk. Mm-hmm. If that tenant went bad, guess what? We're in big trouble. That building now has no income stream. And so we decided to shift to multifamily, where we have 200, 300, 400 families in a building that's in a DST. Tenants come, they go. 1 year leases, so every year we can raise the rent. And we have been able to exceed the rate of inflation in multifamily. That's our mantra, is a stable cash flow and growth. We have a economic advisor, Dr. Peter Lindemann. You might have heard of him. He's on the Walker webcast with Willie Walker all the time. Walker does Capital Square's debt, and Dr. Lindemann's our economic advisor. And he told us, he wrote a white paper and told us that over 40 years, you would have never lost money in multifamily unless you over-leveraged. And we don't over-leverage. We're 30, 40, 50% leverage. And he said you would have always exceeded the rate of inflation over a significant period of time. And so we left net leases that were very easy to manage, right? There's not much to manage. And went to multifamily. That's an enormous management lift. We took on 300 plus property managers to manage our 65 multifamily communities across the Southeast. But now we're dialed in. We're managing our properties and we're getting a better result. We prefer multifamily, but could be hospitality. You understand you have some hospitality roots. Is that right?
That is correct. Yeah, you nailed it. I was going to be right. You stole the question out of my head.
So you'll put a master lease on top of the thing and pay a 7% when you're making 15%. God forbid you don't have a RevPAR problem, Right. You're just going to pay a stated rent to the owner. You can operate the property under a master lease.
I see.
And you're going to make
the master lease is what gets paid out to the
investors.
To the investors.
Right. You keep the difference because you're operating and running the risk, and you have the staffs and the overhead and all those things. Man. You do the PIP when the time comes to buy the darn thing and have to deal with the franchisors.
It's a lot more lucrative than just a regular syndication. I mean, for the general partners too.
Yes, it's very lucrative, but it can turn around on you.
Sure. Yeah. Because you basically, I mean, yeah, it can definitely, yeah, I could see where it could go bad, for sure. That is a very interesting concept. Well, Louis, I gotta ask, because I've been known to bash REITs every once in a while online. I am not What's that?
You've been known to what?
To bash REITs every once in a while
Like
online.
to bash them. Okay.
I like to bash them. So here's my argument, right? And what you're talking about is completely different strategy than what I have in mind. Because what I think REIT, okay, I think somebody is investing cash into a REIT to get real estate exposure.
Right.
In my opinion, that's not real estate investing for a couple of reasons. Number one, you don't get any of the depreciation benefits when investing into a REIT that you could when you like invest into, say, a syndication, right? So if you are investing into a REIT with cash, I feel like that's a much different strategy than the one that you just presented, which is I'm going to exchange my property into a DST, get it absorbed by this REIT.
Right.
To me, that seems like a really good strategy, to be honest.
Your depreciation. You still are allowed depreciation, bonus depreciation. You get a deduction for taxes, insurance, all the benefits of being an owner. You're just now a small owner of a big pool of properties.
Well, hold on a second. So, because when you're invested, say, into like one of the REITs on the exchange, like if you're investing, say,
I was talking about the OP guys. They're still owners of real estate.
Okay, so it's a different set of rules then.
Yes, the stockholders are just investing cash.
Yeah,
they're making a financial investment.
Yeah,
the ones that do the UpREIT are owners, and they're making a real estate investment. They're still real estate investors with all the benefits.
You hear that, everyone? That is crazy. I learned something new today. I did not know that. So that's why I love having people like you on, Louis. I mean, this is I learned so much on this show. So
it's just a gold mine today.
It really is. No, and so okay, that makes a lot of sense to me. A, B, I would actually say that, like, well, let's go back a little bit, right? So the tick strategy, that's a strategy that I'm familiar with. And we've had other folks on the show that have used the tick structure for their own syndications. Your argument is that now the tick, number one, it's you got to put more eggs in the same basket, right? Which I would agree with you. Like, I'm actually involved in a hotel deal right now in Tampa, and we're looking to bring in a tick member, but we set the minimum at $1 million, right? Like, hey, nothing less than $1 million. But the DST allows you to diversify, even if the DST is a single asset investment, you can split up your, let's say $1 million.
Invest in 10 DSTs, 100,000.
Exactly.
If you wanted to.
Right.
And it's not hard because there's an electronic file of all the stuff. You don't have to do the due diligence.
Yeah.
If you had to go out and buy 10 properties and do the due diligence and originate loans, impossible. But the sponsors do the work by finding the properties, doing the due diligence, arranging the loans, having all of the stuff in a Dropbox, easy to access and to understand. No time.
Mm-hmm. Okay, so now I'm going to ask a selfish question. What is required to create how would someone like myself create a DST to do a hotel project? Like, what would that look like?
The DST is just an entity. We used to form limited partnerships, and then we formed LLCs, and we have DSTs. Your legal counsel would describe to you what's required to check the box. And the first thing they'll tell you is you'll need a master lease on top.
Yep.
And all of those economics are worked out because the REITs that own hospitality use master leases. So if you take Apple Hospitality here in Richmond, Virginia, where we live, they have hundreds of properties, and every one of them in their REIT has a master lease on top of it. That part's easy. What's not easy is if you want to raise capital through broker dealers or RIA wealth managers, now you have to go through a process of becoming a sponsor. And that is onerous. There's a bias against first funds. And so And everybody was once a first fund, but in 2012, they said, we know you have a track record as a lawyer. We know you were with a company that was the biggest sponsor, but now you're doing it on your own, and prove to us that you can be a good sponsor. And we've done $8 billion of properties, so we don't have that discussion anymore. But in 2012, we had that discussion. And a lot of registered reps who sell with a commission, or RIAs who don't charge a commission, but make it asset under management, will say, I'm not investing in you until you prove to me that you're worthy. So DST is easy if you're not raising capital through the broker dealers or the wealth managers. If you are, you have to go through a process. One of the more difficult parts is getting an independent due diligence report on you as a sponsor. Yeah. It's a full proctoscopic examination of all your parts and your documents. And it is expensive and painful, but if you're qualified and you're patient and you work through it, you can have your first deal in the market in 6 months or so.
Yeah. I'm assuming the legal process is quite expensive to get all that done.
It is, except I'm a damn lawyer. So for me, it's easy. Yeah. But when we formed, a bunch of my colleagues who were tired of billing hours joined.
Yeah.
And so we have 4 other lawyers in this office. We don't use much in the way of outside counsel. We do our own. We've done billions and billions of dollars of offerings of all types. And so one of our competitive advantages is having the lawyers in-house instead of having to call and pay $1,000 an hour to be told whether you can do something or not.
Yeah. Yeah. That is definitely an advantage. That's really, that's really fascinating. Everything that you just said. Last thing on that note, and then I want to come back to the depreciation benefits and how that and how that's held onto by the owners or the operating partners rather, with the DSTs and the way that it's structured. You mentioned something earlier, and now I've lost my train of thought. You lost yours earlier, and now I'm losing my train of thought. Okay, it'll come back to me, but in the meantime, I want to ask you about how the operating partners, what allows them to hold on to those depreciation benefits, and how that works in the structure of the DST / UpREIT.
Sure. When we exchange into the DST, that's Section 1031.
Yep.
Your tax basis carries over, and now you own a piece of a building fractionalized under revenue ruling. When you contribute your DST to the operating partnership, similar, your basis carries over. And now instead of being an owner of a fractionalized building, you're now the owner of the REIT's limited partnership. And so you now get the benefit of the REIT's real estate depreciation, all of it across the board. You get your piece of the depreciation.
Yeah.
So if you had a $200,000 tax basis in your $1 million investment, you would have $200,000 to depreciate. The partnership would do a old-fashioned K-1 return for you. It would send you your return that would show your share of the deductions for taxes, insurance, maintenance, repairs, and your bottom line taxable income after your basis.
I see. So it works basically. It's very similar. Very similar.
It's very similar. When you're a DST owner, each DST owner has their own independent tax basis. They're not in an entity. They're all coming from a different property.
Yeah.
So each DST owner does their own tax return. The sponsor doesn't know your tax basis. There's not an entity. It's sort of a fractionalized ownership. But in the operating partnership, you get a K-1. The sponsor does the tax return, sends it to you.
Okay, so in the DS... sorry, what was that last part?
It's a little bit easier because the tax reporting is done for you.
Yeah. So the master, let's just say you used the 7% earlier. So let's say that there's a 7% master lease. That's what's getting paid out to the operating partners of the DST, right? The investors, right?
Absolutely.
Do DSTs and also UpREITs utilize things like cost segregation, bonus depreciation benefits?
On the DST side, Capital Square has a cost segregation study done on every multifamily property.
Okay.
We have for years, ever since the Tax Cuts and Jobs Act in 17 gave us 100% bonus depreciation.
Yep.
We started getting cost segs on everything. Some REITs have them and some don't, but it's definitely an option for a REIT. When a REIT buys a property, they could have cost segregation. When there's a contribution, it's less likely that there'd be a cost seg.
So I see. So when there's a contribution from the DST to the, then less likely, because what's the point? This is already a stabilized asset.
Right.
Right. Makes sense.
Yeah.
So,
and one more thing in
yes.
in the one big beautiful bill.
Yep.
The OB3, bonus depreciation is back to 100%.
Yes, sir.
Going back to January of this year, but it sunsets in a decade or so. So we'll have to fight that one again in a decade.
Yeah, who knows what'll happen, but it is a beautiful thing, and I think that that was one of the things that I was very excited about with that piece of legislation. Coming back to the depreciation, so the master lease, right?
Yes.
In many cases, especially with 100% bonus depreciation back, year one, year two, and sometimes even year three, like
no
the write-offs. Yeah, exactly. So the master lease gets wiped out basically, like in terms of tax. So that's all, like that income is not taxed, correct?
And then you may have excess losses that you can use against your other real estate.
So so it passes through the same way that it does in a real estate syndication. How is that operating agreement set up? Like, is it different than a syndication where it's like, hey, just 7%? You're like basically a 7% owner, or like, how does that work? I guess 7%, that wouldn't make sense, but like, how is the percentage interest calculated?
Let's say you're taking your $2 million into a $200 million REIT.
Yep.
You would be a 1% owner, 2 million. Okay. You get a certain number of OP units, but it's really just proportions.
Okay. Understood.
And the REITs pay, 5, 6, whatever they pay in their dividend, that's paid on your OP units.
Yeah. So it's not percentage of the equity, it's percentage of the value of the asset.
Basically. It's
okay.
Just simple fractions.
Yeah. Okay. Makes sense. And in the UpREIT, would the same rules apply? Meaning, like, would those write-offs then get passed off to the operating partners of the REIT?
Absolutely.
Really?
Absolutely. Yes.
Interesting. Okay. So I guess when I talk poorly about REITs in the future, I should always make a caveat.
Yes.
Only for cash investors.
I mean, you're real.
What's that?
The people that instead of buying a hospitality asset, they can UpREIT the hospitality asset and take back OP units and just have an income stream and let you, the operator, do the heavy lifting and become a passive owner. A lot of them are selling because they're tired of the effort it takes. They want to liquefy. Mm-hmm. If they liquefy, it's taxable. If they contribute to a REIT and take back OP units, there's no tax. Mm-hmm. I meant to say 1031 is, exchange into DST. When you UpREIT, it's section 721. There's no tax. Your basis carries over, similar to 1031. Yeah. And so a lot of whole property owners who are tired of management will contribute their whole property, not a DST, but the whole property into the operating partnership, take back OP units and become a passive owner with the real estate benefits of depreciation and deductions and a nice cash flow without having to do the work any longer.
Is that the strategy that you see a lot of REITs use? Is that UpREIT mechanism to bring more assets into their? Yeah, I mean, that makes sense.
Absolutely. And it works like magic. We're in the process of 2 or 3, not DST UpREITs, but whole property UpREITs. And in each case, the owner has owned a property for a very long time. They're exhausted by the effort of management. They're not large enough to have economies of scale. So they don't have a Lloyd's of London syndicate like Capital Square does for insurance. And they don't have Walker and Dunlop for debt. And so they really can't operate efficiently. They're what we call Post-it note managers. They manage on Post-it notes on their desk instead of modern systems. And so for them to get out of the active management is a wonderful thing. And it's also creates better economic results by using modern management techniques, revenue management on the apartments to tell you what, every lease has an optimal rate. To have revenue management, you have to be a pretty big operator. And most of the guys that are UpREITing are smaller, more ma and pa getting out of active management, but they don't want to pay the tax. Okay. So they could 1030, they could sell their asset, do another exchange, but they can end up in the same boat. By UpREITing, they can get out of active management, right, and have that nice cash flow.
Yeah. No, I mean, it makes perfect sense, right? Because at some point, you're right. I mean, having been in this space for a long time, eventually every real estate investor gets tired. It might be 5 years, it might be 10 years, it might be 30 years, but at some point they all tap out. Now there's a few of them that they're just, they're weirdos and they do it until they die and they love it, right? But the majority of the people, the investors that I know do get tired, and DST has always been something that I've been a proponent of. The tick structure is something that actually came, I only found out about a few years ago that you could even do that. But there are a lot of, there's a lot of headaches involved with the tick structure. Not going to lie, it's not simple. It is quite simple. Yeah, and it has to do the job properly. Each tenant in common has the right to vote on all things that are material. Mm-hmm. And you just want to make sure that your co-ticks are going to cooperate when something is needed. I remember what I was going to ask you before, by the way. Okay. So the Commanders are going to have a great season here. We're in Richmond, Virginia, and it's almost football season. So go Niners. Go Niners. Yeah, that'll be nice. They're an excellent team. We just made a trade today. Did you see that? No, who'd you pick up? You guys traded your Brian Robinson, I think, the running back. Yeah, to the Niners for a 6th-round pick. He was a good running back, but apparently there's 2 young ones that are just as good and don't cost as much. Yeah. He's a good running back. I hope he's successful. I mean, I don't know anything about him. I just saw the headline this morning as I was running into work. So I'll do a little bit of research later. I think there's a backstory. If he's the one I'm remembering during COVID, he got shot. Because really? DC is such a safe place to live. Yeah. But he recovered and came back and has been a good running back. No kidding. Oh, that's crazy. Google it. Oh, you know what? That makes sense why I saw this meme, because the guy, the receiver on our team, Ricky Pearsall, you heard the name? Yes. So he got shot before his rookie season last year in San Francisco. And then they had a thing that's like, hey, it's amazing that these 2 players are on the same team. I thought they went to college together, but that makes sense. They both got shot. Another safe city. Yeah. No comment. Gosh, no we don't kidding. Talk politics. No, exactly. We do not talk politics on this show. Really quickly, and then I know we're running out of time here, Louis, but wouldn't it? So you talked about raising from the broker-dealer community, RIAs, which makes a lot of sense. But I mean, to me, right, especially RIAs, broker-dealers, that they deal with more security, broker-dealers now, but securities and equities. But if you're really going after people that are exchanging, right, wouldn't it make sense to just go directly to the source and talk to investment property owners, more like a B2C as opposed to a B2B strategy? Doesn't that make more sense, or is it would just not a scalable? It would make more sense, but the DST is a security for securities laws purposes. And so to earn compensation, your trustee realtor can't charge a commission on a DST because it's a security unless they have securities licenses. Right. So kind of, you've got the real estate guys here, and then you've got the securities guys here. And we took this real estate and made it into a hybrid that's a security, and the realtor can't get paid on a DST sale. They can get paid on the sale of the real estate, real estate,
the
right?
sponsor buys the property or sells the property, there's usually a real estate broker. But the DSTs are sold through registered reps or RIAs who don't charge commission, but have licenses to sell securities to investors. It's a different track.
I see. I mean, that makes sense, right? Like, if you want to, I guess, go to somebody that can get you access to those people that are going to get paid for it. But couldn't you actually just go to a bunch of realtors and say like, hey, I'm going to help you make a commission on the sale of that property?
Not practical.
No, not practical.
For a realtor to put together a DST?
No, not put together the DST, but rather, I see what you're saying. So
they can't get paid on the DST.
No, I understand, but they could get paid on the sale of the property.
And they probably will. There's surely if you have a $100 million DST property, one of these big, beautiful buildings, it's going to market with one of the top brokers in that region. They'll earn a brokerage commission on the buy and the sale. But now we're talking about the fractional interest in the DST.
Right.
It gets sold through a different group of registered reps or wealth managers.
Makes sense. Yeah. I see what you're saying, though. The broker dealers and the RIAs would have a pulse on who is interested in exchanging into a DST.
And they specialize. So they're out there with their marketing and their, network of people that know I specialize in DSTs. I can show you 5 or 10 different programs at any given time.
Yeah.
You want all cash, you want leverage, you want whatever you want, the smorgasbord of rep, especially the reps who specialize in 1031, have a phenomenal pipeline of properties, and they have history, 10, 15 years of experience with the sponsors to guide investors. You're a regular person, you sold a duplex, and now you're going into broker dealer land, buying a security. You need somebody to help you through that process to make sure that you're dealing with a reputable sponsor and the documents are customary and it's a fair deal. You wouldn't know as an investor. You've never done this before in many cases, so you need a guide.
Right. Well, and that's why I was asking, because when I was younger, I was 23, and we had an RIA come into my brokerage. I used to sell residential real estate, and he explained to all the agents. He taught us about DSTs. So I learned about DSTs when I was 23 years old.
Nice.
And so this guy, but he was also a qualified intermediary. And so I guess I'm thinking from a lead generation standpoint, right? Like, cause I'm a marketing guy, sales guy. So like, I'm always thinking, how could you like create a funnel to like give more people, that are going to do exchanges? So it sounds like maybe like, do you guys work with QIs at all then?
We do.
Okay. And like you try and like get them to funnel people over to you, or like how do you workouts? Typically
work with the registered reps and RIAs.
Yeah.
That's the best. That's our platform. That's how we've done $8 billion. We're not staffed to handle the we have 7,000 or 8,000 investors for quarterly updates and things like that. But we're not a direct sales machine.
Sure.
We're best working with the registered reps and wealth managers that have the customer and have that relationship.
Yeah.
Know their investor, know what they need. We create a product, and with their help, we collectively sell it.
It's a lot more scalable that way. I could definitely see that. It's definitely a lot more scalable. Louis, you have been a treasure trove of knowledge, but I can't let you go without sharing one final investing secret with the audience. I will let you take it away.
Go for it. I want to know your investment secret.
Oh, you want to know mine?
Target on you. Your turn.
Oh my gosh. No one's ever done that to me before. That's crazy.
Give me something I can use. I need all the help I can get. It's until the Fed reduces the 10-year Treasury to 4% again. We're scrapping and fighting, trying to make deals work.
Oh wow, this is dude. I cannot believe you're putting this on me. Well, here's what I know is that based on the dozens now, no, like over 100, I think, guests that I've had, almost 100 guests that I've had on the show. I think the one thing that comes up over and over and over again, Louis, is this idea of like being okay with taking calculated risks. You know, I think that investing is a series of calculated risks, or like seeing a successful investor. It's a series of calculated risks that go right. And there are failed investors who take some risks, it doesn't go well, and then they stop. Right? They don't pick themselves back up and keep going. And so I guess the thing that I'm been gaining from all these conversations over and over and over again is the idea of like, and even you know, like we didn't really go into your story that much, but like everything that you did, Louis, like there was risky. Like setting up all these different, like setting up Capital Squares. I mean, there's risk in that, right? And you assume that risk, like you said before, with starting a DST, like that is risky.
I cashed out my little lawyer retirement account to buy the first property to have something to sell into the DST. And after about 10 years, I paid myself back. Yeah. But you didn't talk about that. But here we are talking about it now. Because even though you didn't, just goes with the territory. Yeah. That if you're the sponsor, you have to spend the money and create the investment. 100%. So that's my investing secret. Excellent. You got off scot-free there, man. I did. But I pulled that little nugget out of you at the end. So if you're listening, everyone, like Louis did $8 billion worth of transactions in the last 10 years. Yes. But he took a massive risk to get to that point and took many risks along the way that panned out. And congratulations to you, man. Didn't lose awesome. Any sleep over it. Yeah, I'm sure. Not much. Louis, this has been a pleasure, man. With people that want to find you online, where can they find you? CapitalSQ.com or Google me, Louis J. Rogers. If you have $12, please buy the little book. All the proceeds go to the Children's Hospital of Richmond. It's a $12 book, but it could save you $12 million in taxes over your lifetime. So please, wherever books are sold, buy the book for the Children's Hospital of Richmond. I love that. That link will be in, we'll grab that link from you and from your team, Louis, and we'll go ahead and put that in the description in the show notes. Louis, thanks for stopping by. If people have questions, if they can funnel them somehow through you to me, I'm happy to answer questions of any type. All right. You heard that. In the description box below, you'll see a way to submit your questions to Louis. Excellent. It's lots of fun. Yes. The price of gold is going up. Get ready. Buy some. Love it, man. Thank you. Thank you.